So in the next topic in the series of 10 important keys for the stock market success is stock market psychology. Most of the participants in the stock market are traders. They have huge positions in the stock market for a short time. Stock markets works on the psychology of greed and fear. Since most of these traders have borrowed finance for this position, the factor of fear is substantially high for them. This leads to the panic. Also, when there is a profit, because of the greed, they will have a strong temptation for booking the profit. Investor needs to understand this psychology. If they have a good stocks, this greed and fear factor should not impact them on daily basis, because the horizon of the investment is longer time. Most of the time the activities or greed and fear factors are best for short time factors. So we need to classify these things from short term to the long term. Since we are talking here the investment, which itself means it is for the longer term, the degree of greed and fear in the longer term is much different than the degree of the same greed and fear for a shorter duration. So those who are investing, they should not be putting the concern all the time regarding the short term pain in the stock market. So it is important that they should not be always, as I told you, there's more traders are working in the stock market, and their vision or their perspective is a very short term. So their strategies are also for the short term. And if you are a long term investor, that strategy should not impact on your investment decisions. So there is no need to have a herd mentality based on what other trader or short-term investors are doing. You need to analyze and decide based on your overall perspective. The next factor is assessment of yourself. Before entering in the stock market, or even if you are working in the stock market, you need to have reasonable assessment of your own. That is your financial risk-taking ability, financial obligations. Normally, the people having very high financial obligations are not they do not have a very high risk taking perspective because of the obligations, so they cannot take higher risk. So we need to have a very clear understanding on these factors. Goal over the period of time, it is like making a small profit in the short term, or keeping the investment for the longer period of time and with certain goal in the mind where that investment will be used in the future. Contingency plan: if something goes wrong in the stock market for some period. Are you dependent on that investment? And if yes, what could be the contingency plan in that case? Do you have any backup, or you are that money what you are invested has no impact from the contingency planning point of view? And the last thing here is amount of time and efforts one would like to devote on these activities. Because if you have less time and less amount efforts can you if you can put, then your selection of the stock will be different. And at the same time, if you can devote more time, more reports, more efforts, then in that case the stock selection could be different, where you have to monitor very closely for that particular stock, their news, their events, positive or negative impact on any other perspective on those particular stock, that you need to monitor very closely. So based on availability of your time and efforts, your portfolio will be different. So that is also a very important thing, because if it is not possible to monitor on continuous basis, you can always go with the blue chip company or the large cap companies, which are more stable, but their output or their return may not be that high with some other mid cap stocks. All right, so thank you very much. Thanks.